This year has started in a positive way for financial markets, with the majority of leading equity indices making gains over the month. Some key markets, in fact, had their best returns since 2019. So starting with growth assets, one of the main reasons for the rise in global equity markets was some hopeful signs from the US economy that it might avoid a hard recession this year. Sentiment was boosted by the US economy showing a solid, albeit slower, growth rate ahead of expectations over the final quarter of 2022, with a 2.9% increase, raising hopes of a soft landing. In Europe, again, some encouraging economic data has helped ease worries over the pace of interest rate tightening and led to positive returns from European growth assets. This positive sentiment around the likelihood of a recession was confirmed by the latest IMF report, which said the UK is the only major economy likely to shrink this year. So important US inflation data came in line with expectations this month, as the Fed's preferred inflation gauge, which is the core personal consumption expenditures, now this excludes food and energy, that index rose 4.4% over the year ended in December. Now that's still above the Fed's 2% long-term inflation target, but well below its 5.4% peak in February 2022. In fact, it's the slowest pace in 14 months. January saw the US hit its debt ceiling limit once again at an astronomical $31.4 trillion. Now, the Department of Treasury has been undertaking a set of extraordinary measures, so the debt limit does not apply just yet. Now, the Treasury estimates that those measures will be adequate to get through till early June. So turning to China, financial markets were closed for the Lunar New Year holiday, which started January 21st and reopened at the end of the month. China's domestic activity picked up considerably during the week-long holiday, increasing confidence about a faster than anticipated economic recovery as people enjoyed the break from COVID restrictions. Looking at factor performance, after a difficult period recently, growth was the best performing factor over the month, followed by small cap. And this reflects the risk-on sentiment we've seen over the month. This also had a positive impact on ESG funds, which typically have a larger weighting to growth areas such as technology. Now, the recent recovery in pricing of defensive assets also continued, with the US and UK 10-year yields both falling from the start of the month. And this is because markets are continuing to price in a peak in interest rates this year. However, worries still remain about the inverted nature of the yield curve. This is where the yield on long-dated bonds are lower than a short-dated bond, and this unfortunately still points to a recession. So in summary, January has started in a positive way for equity markets, but caution remains the watchword, as more economic data will be needed to evidence we are not facing a recession this year. No doubt there will be more market noise driving the short-term direction, so keeping a well-diversified portfolio remains the key for the months ahead.